Hello and welcome to lecture 3 of the Fiat standard course. Today's lecture's topic is Fiat technology. We're going to open the hood of this machine and look at how the engine and how the technology behind it actually functions. Now, as we did with the Bitcoin standard, this is going to be an attempt at an engineering study of how the thing actually functions. So we're trying to get away from the political propaganda of how this thing is supposed to function. We're going to get away from all of the advertisement that people give and the rationales for why this actually should function like this. And we're just going to try and look at it dispassionately to see how the network functions by drawing an analogy to how Bitcoin functions. So as I did with the Bitcoin standard, after studying Bitcoin, I came up with a definition of what I think Bitcoin is. I'm going to begin by first presenting what my definition of fiat is. And I think we can define fiat as a compulsory implementation of debt-based centralized ledger technology, monopolizing financial and monetary services worldwide. I think this is a good way to define it because a defining feature of fiat is that it is compulsory. It's everywhere in the world. You have to use the fiat network to pay taxes to your government or you go to jail. It's debt-based, which I think is enormously important. The native token really is debt. And it's, the term decentralized ledgers has been popularized since the rise of Bitcoin. It's become such a big buzzword. But really, fiat is an example of centralized ledger technology, and that's not necessarily a bad thing, but it's extremely centralized in that it's all centralized in banks and central banks, and then the central banks themselves are centralized around one ruling central bank that decides pretty much everything on the network. This ledger technology monopolizes all financial and monetary services worldwide, at least until the invention of Bitcoin. Before that, you had to use that network for all of your monetary and financial services. The fiat standard, to continue my definition, the fiat standard was born out of the need for governments to manage their de facto default on their gold obligations. It was not designed to optimize the user experience of currency transactions and banking. I think this is an enormously important point that gets overlooked, and that was really the essence of the previous lecture in chapter 2, in that governments were defaulting on their liabilities to pay gold for the holders of their currency, and then they had to come up with this bastard child, effectively, to justify and manage their defaults. This was not something that was ever designed consciously and presented to users to adopt. It was not something that was ever put to a vote. It was not something that was ever discussed in a parliament. It was really illicit in the way in which it was introduced. It was it was not honest, and it was presented as if it was a temporary measure, but then it became a permanent measure, and it was never really designed consciously. I think this is a very important point in time. Now, to think about how fiat works, it's important first to understand that modern fiat money is not just conjured out of thin air through government fiat and handed out to people. Most people think of government as having printers where they just print paper money and hand it out to people, and then people use it. And that's not true. We've never had an example of a fiat money that has come to existence through this process of government just going and saying, hey, here's pieces of paper with the picture of the king or the president. Let's hand them out, and then let the king and the president, and then everybody needs to use them for payment. This has never happened. It has always come along as a default on government liability. So every fiat currency in existence was at one point backed by gold, or it is backed today by currencies that were at one point backed by gold. We've never just had fiat emerge ex nihilo. This is just somebody prints a piece of paper and then everybody starts using it as money, and it gains value spontaneously. It only gains its value because it was backed by real money, gold, and then people start using it, and then the government defaults on its liability. So modern fiat money is far more sophisticated and convoluted in its operation than just printed pieces of paper that governments hand out. The fundamental engineering feature of the fiat system is that it treats future promises of payment of money as if they were as good as present money, so long as they are issued by the government or an entity guaranteed a lending license by the government. This really is the key property here. If you are able to issue Debt, if you are able to issue liabilities, then that debt can be used as money. It's a form of money, as long as you are either a government entity or a private bank that is banked by the central bank, which is effectively a government entity. So effectively, with fiat, government credit allows non-existent tokens from the future to be brought to life to settle transactions in the present when a loan is made, allowing the borrower and the lender to have a larger amount of fiat tokens between them than when they started, thus devaluing the rest of the network's tokens. The fiat network creates more tokens every time a government licensed entity makes a loan in the local fiat token. And so, having been born out of government default, the essential characteristic of the fiat standard is that it uses government decree as the token of value on its monetary and payment network. Since the government can decree value on the network, it effectively makes its own credit money. That's how this machine works. It runs on government credit and treating government credit as money. So since the government backs the entire banking system, this makes all credit issued by the banking system effectively the government's credit, and so part of the money supply. In other words, the US Congress and Federal Reserve are not the only institutions capable of conjuring money from thin air. Any lending organization also has the capacity to increase the money supply through lending. So I give this example, which I think is very pivotal towards understanding how lending creates money in the fiat monetary system. So in a gold monetary system or in the Bitcoin monetary system, if you want to buy a house, you need to present the gold. The gold needs to be present, and you hand it to the seller of the house, and when you give him the gold, he gives you the house. Similarly with Bitcoin, you need to have command of the Satoshis and then hand them over to the owner of the house, at a particular block time. There comes a block's height at which the coins are transferred from an address which you control to an address which he controls. And at that point, he hands you over the house. So the house is a present good. You live in the house today. You consume it today. Yesterday it was his house. Today it's your house. Similarly, the money, gold or Bitcoin, is also a present good. Yesterday the gold was yours. Today the gold is his. Yesterday, or previous block, the Bitcoins were yours. This block, the Bitcoins are his. So a present good is exchanged for a present good in a Bitcoin or gold monetary system. With fiat, it's much more complicated. So when you want to buy a house, now, you can do that sort of thing if you pay cash for your house or if you pay with your own savings. So if you take money from your saving account or your checking account, or you take a suitcase of cash and you give it to the homeowner and they give you the house, then the transaction is similar to what happened in the case of gold and Bitcoin. You had present cash and you handed it over, and they gave you the house. But that's not what most people do, as we're going to see. There's an enormous incentive for getting into debt. So the vast majority of people who make large expenses and large purchases, whether it's a house or a big investment in a big company, they make these purchases by borrowing. And when that happens, we're going to see the incentive for doing this, why it makes sense for fiat. And I think this analysis of fiat as a monetary network helps us understand the pervasiveness of debt in the fiat monetary system. So when a client takes out a $1 million loan to buy a house, the lending bank does not take a pre-existing mature $1 million that is present in its cash reserves or from a depositor's balance at the bank. They don't just take your money from the bank or another depositor's money from the bank and hand it to you to give to the house seller. The bank will simply issue the loan and create the dollars that are used to pay the seller of the house. These dollars did not exist before the loan was issued. Their existence is predicated on the borrower fulfilling their end of the bargain and making regular payments in the future. So you didn't have that $1 million before you had the house, and the bank did not have those $1 million before you had the house. But now the $1 million has been conjured by the bank, and the bank and the house is now yours. So you got a house, which is a present good, which you can live in and you can use and consume. And you didn't have to give anything up, nor did the bank have to give anything up. The money was just created by the bank. So no present goods are used in the home purchase. No saver had to set the tokens aside to give to the borrower to pay the house seller. The present good of the house is handed to the borrower without them having to offer a present good in exchange, and the house seller does not grant the credit to the borrower nor take on the risk of default. So the bank grants the credit, and the credit risk is ultimately borne by the central bank guaranteeing the bank, the loan, and the currency. Had the house seller granted the credit, they would be taking on the risk of default and giving up their present good willingly, affecting no other parties. But by utilizing the fiat standard, the house seller receives their payment in full upfront, and the buyer receives the house in full upfront. Both parties walk away with present goods they can use in full, even though only one of these goods existed before the transaction took place. So after the transaction took place, you own a house, and the previous house owner owns $1 million that they can spend immediately today. They have that $1 million that they own today, which did not exist beforehand. So nobody had to sacrifice a present good in order for you to gain that house. The new fiat tokens created to allow this transaction place the risk of the buyer defaulting on all holders of the currency.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, The Bitcoin Standard, The Fiat Standard, and Principles of Economics, and you can also get copies of Lynn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters, and Mexican billionaires Ricardo Salinas Pliego's new book, The Bitcoin Enlightenment. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesafehouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight Computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249.
So the transaction only works by externalizing the risk to society at large, protecting the buyer, seller, and bank from default by having the government's currency holders effectively absorb the risk premium through the inflation of the money supply. To create an analogy with Bitcoin's operation, we could say that the fiat network creates or destroys a number of new tokens with each block, equal to the amount of lending that has taken place minus the amount of credit repaid and defaulted on. Rather than a set new number of coins to be added with each block, as with Bitcoin's protocol, the number of fiat tokens added in each fiat time period is the net result of debt creation, which can vary widely and can be positive or negative. So with Bitcoin, we know with each block how many new coins are going to be produced. Currently, it's 6.25 new coins that get minted with each block every 10 minutes. With fiat, every day, new loans are issued and old loans are paid back and old loans are being defaulted upon. And all of these things are creating more money and destroying the money supply. And so the amount of money that gets created on any particular day is unknown, really. It's unpredictable, and it's also really unknown because you can't really keep track of it in real time, keep track of every lending operation in real time. So understanding this idea of lending as mining and lending as the way in which money is created is pivotal toward understanding how the fiat network functions. So now we move on toward discussing the topography of the network. Well, the network is made up mainly of 190 central banks. You can think of these as the nodes of the network, and they are the members of the IMF, the International Monetary Fund. There are thousands of private banks with many, probably tens of thousands of physical branches all over the world. And these banks all utilize a highly efficient centralized ledger technology. It's much more efficient than decentralized because there's one authoritative record and one full node that decides which transactions are valid and which transactions are not, and which nodes can operate on the network and which nodes cannot. And so that one full node is the US Federal Reserve. So all banks are centralized, all their ledgers are centralized and supervised by their local central bank, but then all central bank transactions and all their ledgers are centralized and supervised by the US Federal Reserve. And so the US Federal Reserve has the ability to basically kick any member of the network off the network. And so we saw this recently with sanctions against Russia, where Russia was just basically kicked off the network and they had their balances confiscated. So the Russian central bank's dollar balances were confiscated. And they were kicked off the SWIFT network, or several Russian banks were kicked off the SWIFT network, which is basically the network that allows the messaging of transactions and the debiting of accounts between individual banks and central banks across the world. The native token of this network is debt, and it is denominated in US dollar. You could say that the native token is the dollar, but I think it's more accurate to think of it as debt, where the denomination is US dollar. And then there are the national currencies, with their own little insignia and colors and flags and dead presidents on them. But ultimately, all of these currencies, you can think of their value as being basically the US dollar plus the country risk. If you look over the last 60 years, there hasn't been a currency that has managed to appreciate significantly against the dollar in the long term. Currencies will either be pegged to the dollar or they will devalue next to the dollar. You can't beat the king in this game. And that's due to a variety of economic and political reasons. The economic reasons is that the dollar has the most salability, and it is the one that that can travel around the world easiest and fastest, and is the most accessible and most acceptable around the world. And so generally people prefer to hold the dollar to whatever other currency there is. And also, the US government doesn't look too kindly on governments having stronger currencies that threaten the status of the US dollar. And so they will bring pressure to bear on governments to devalue their currencies if they get too strong, which is what happened in the case of Switzerland in the 1970s. And so the value of national currencies basically tracks the dollar. And then it's got a negative premium, which is equivalent to or a discount, which is equivalent to the country risk, the amount of risk that is associated with the country and the risk that there's going to be inflation or hyperinflation associated with the growth of the country. The key insight of this chapter, and I think maybe one of the key analytical points of this book, is that the equivalent of mining in the fiat system is lending. The way that lending works in fiat is that lending is how new money is created. So in Bitcoin, we have the proof of work system. In gold, we have people digging underground and taking chunks of rock and then refining them and taking the gold out. In the fiat network, there's lending is how money is created. So there's a complex web of government rules and regulations that determine how an institution can obtain the lending license that allows it to issue loans. These rules or regulations are typically promulgated by central governments, central banks, the Bank of International Settlements, or the IMF. Unlike with Bitcoin, there's no easily verifiable proof of work protocol and no algorithmic adjustment to ensure the fiat coin supply remains within known and clearly auditable parameters. This prevents the emergence of a free market in capital and money, and the interest rates in this network are set by the full node. Basically, the US government is the one that sets the ones that sets interest rates to its primary dealer banks, the main and most important banks in the US. And then these interest rates are reflected across the world, where they rise and fall. Well, they rise basically the further away you are from the US central bank, the higher the interest rates that you would have to pay to borrow. So this, I think, gives us a good idea about the basic operation of fiat. But the way that it really works in the 20th century, the way that it has worked primarily, is the function of these nodes, which are the central banks, which you can think of as the main entity that performs the monetary functions in this. Similar to like the node in a Bitcoin system, central banks have 4 important functions, kind of analogous to what a node does, but more sophisticated and more problematic, if you want. The core functionality of how fiat functions, how a fiat node functions, lies in 4 areas. So your central bank has 4 main functions. And these are very important functions that are all assigned to one entity, which is the central bank, which is, of course, provided a monopoly by the government. It has a monopoly on providing the domestic fiat coin and determining its supply and price. So central banks have a national monopoly in their territory, where they're the only ones who are able to provide currency. And they're the only ones who decide the supply and the price, which is the interest rate. Now, they're not always very good at determining, at controlling the supply and the interest rate, but they're the only ones who can try to do that. So they have a monopoly on supplying the currency and printing and making the currency and issuing debt and determining the interest rate by which the supply gets manipulated and increased or decreased. 2, they have a monopoly on international payment clearance. This is enormously important. So your local central bank is the only entity that allows you to trade with the rest of the world. If you want to send money abroad, if you want to buy things from abroad, you have to go through your local central bank. And so they have a monopoly on providing the money, and they have a monopoly on international payment settlement. They also, point 3, they also have a monopoly authority over licensing and regulating domestic banks, holding their reserves, and clearing payments between them. And this is, of course, extremely important. So the central bank is not just in charge of the currency, it's also in charge of the banking system. And therefore, it tells banks what to do, how to, who is allowed to borrow, who's allowed to open a checking account, who's allowed to use a saving account, what interest rates they can charge. And it clears payments between the local banking. So you have a monopoly on the money, you have a monopoly on international transfers, and you have a monopoly on banking. All of these 3 things combined in one institution. And then the cherry on top, and the real problem there, is that you combine all of these 3 enormously critical monopolies, without which a modern economy cannot function, without which a society will basically revert back to barbarism, without which modern civilization cannot function. You combine these 3 functions with the ability of the central bank, this entity, to buy government bonds. In other words, to lend to the national government. Once you understand the role of central banks as being nodes, and once you see that these nodes have much more functionality than a Bitcoin node, you see that these nodes have all of these monopolies together. And this is really a very pivotal point to understand. This is the key thing to understand about how central banks work. Their propaganda literature and all of the garbage that they teach at universities tends to present them as heroes out there that are doing God's work by allowing us to have money, to be able to trade with the rest of the world, and to be able to run a safe banking system, and to be able to finance government spending. Present these as if they're heroic feats. But these things would happen in a free market. Well, maybe not the lending to the government, but the first three very critical functions, they would happen in a free market. A free market is capable of providing its own money, as we see in the example of gold, as we see in the history of money that we discuss in the Bitcoin Standard. Money is a creature of markets, not a creature of the state. And people will be able to build institutions that can trade with people across national borders. It's not rocket science. Banking can work without the government as well. And thirdly, people can build banks that hold saving account and checking account and clear payments domestically. Again, that would happen in any market economy, any sophisticated market economy. It's just the normal division of labor that these tasks emerge. But in the modern monetary system, we see what central banks do is they monopolize these three functions. So they're not there providing us with those functions. The market would provide those functions. They are just holding a monopoly on them. And the really perverse thing is that monopoly is secured by the government. And that monopoly is secured by the government in order to allow the central bank to lend to the government. That's the very perverse song and dance that goes on. So the government secures for the central bank these three monopolies, and in return, the central bank lends infinite amounts of money to the government, basically. What that means, in effect, is that the government is able to borrow by using all of society's wealth, liquid wealth, as its collateral. That's really what it comes down to. This is what the fiat standard means. By placing all of these critical three functions, the monopoly on currency and the monopoly on international clearance and the monopoly on licensing and regulating the local banking system, by placing banking and trade and money in one entity as a monopoly, that entity can then lend to the government and basically use all of society's money as collateral, because a modern society needs to have a currency, needs to settle international trade, and needs to use banks. So everybody's going to have the majority of their liquid wealth in the banking system. And with that money in the banking system, the central bank uses that money to buy government bonds, and then that allows them to basically lend to the government and finance the government infinitely for as long as the currency works. And so this is an unsustainable arrangement in the long run, but it can take a long time before the long run comes along. It can take a long time for this thing to fall apart. Basically, it is sustainable for as long as the currency works. So for as long as the currency works, this system is allowing the government to continue to borrow against society's wealth. That's really how it works. The Bitcoin Standard podcast is brought to you by CoinKite. CoinKite are my favorite makers of Bitcoin hardware. They produce the legendary Open Dime, the first Bitcoin bearer asset, as well as the reliable Cold Card hardware wallet, the excellent stainless steel seed plates for storing your seed phrases, and the block clock. Now, CoinKite have produced the Sats card, a card the size of a credit card which can store Bitcoin and works great as a gift. CoinKite have just produced a limited edition gorgeous Bitcoin Standard Sats card, which carries the Bitcoin Standard logo, and you can get it from coinkite.shop/Bitcoin Standard. Use the code Bitcoin Standard to get 5% off your purchase. This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently. So, to perform these four functions, The central bank, or the node, the fiat node, has a cash balance, which is commonly referred to as the international cash reserve account. So each central bank will have a cash reserve account in its own currency, but also it has an international cash reserve account in international reserve currencies, mainly the dollar, but sometimes, there are other currencies out there. So what do they do with that international cash reserve account? That backs the local currency. So the local currency is backed by that international cash, and it settles international trade, and it backs all bank deposits, and it buys government bonds to finance government spending. So you combine all of these things together, you see that all that money is combined in one big pot, and that pot is used to basically back the borrowing from the government, back the government's borrowing. So the money that the central bank issues has value because the central bank has foreign currency backing it, or gold. And when all of that money is centralized in one central bank, the central bank can use that money to finance government spending by lending. I think really understanding the economic problems of the world can only happen by understanding this catastrophe of combining all of these four tasks in one monopoly. If you break this monopoly, the world will be such a better place because everybody will be able to pick the currency they want, and then only the better currencies will survive. Everybody will be able to trade internationally with banks freely without having to finance government lending with that trade. And everybody would be able to have their bank deposits stored in a place that is safe because they're not being used to finance government spending. If you had this, it would be an amazing world. But I think the reason we had so much economic problems in the 20th century, so much more than the 19th century, the reason we had so much more defaults and how so many more hyperinflations is because of this arrangement, is because of this insane way in which the international cash reserve account in each country is used to finance government spending. I think one way of understanding the intermingling of all these functions is similar to trying to link in your house. Imagine trying to link all of the sewage water with the drinking water and putting them all in one, mixing the pipes together. So that you're trying to save on pipes. That's kind of how fiat standard works, really. To save on the cost of moving gold, we mix up all of these functions in one monopoly. Similarly, if you were building a house and you wanted to save on pipes, you mix the sewage pipes with the water pipes. And obviously that's going to be massively destructive. You're going to get poisoned and die from drinking sewage. And even if you try and, there are ways to get around this. You could filter the water before you drink it. That's massively expensive, massively inconvenient, and massively much more costly than the simple option of just buying proper piping. Separate these functions from one another. Let currency providers provide currency freely, or let the market choose the currency it wants. Let bankers do whatever they want to do, and let banks offer alternatives to society, and people will choose the banks that don't lend to insane governments that spend money irresponsibly, and let people have the choice to use international banks. But you can't do those things in the fiat system. You can't, you look at countries that are suffering from hyperinflation, for instance. You look at Lebanon these days. The disaster and the catastrophe is because all of these things are linked together. So the government is obviously insolvent because it's an insane government that spends money on all kinds of insane things. But why should this affect responsible businesses and responsible people? Why should this affect somebody who has a profitable business, who collects, makes a profit and saves their revenues in a bank account? Well, now their bank accounts are destroyed because those bank accounts were used as collateral for the government to borrow. Now, you can't just go, foreign banks can't just go and set up branches in Lebanon and allow the Lebanese people to deposit their money in those banks in a currency separate from the Lebanese currency and to settle trade internationally. This just doesn't happen. It's not a lack of entrepreneurship that is stopping that. And if this was possible, the entire crisis would have been over in 15 minutes. If you just had the option for people to not use banks that are controlled by the central bank government monopoly, by the central fiat node, even if you just had free competition from other fiat nodes, let's say the Jordanian or the Turkish or the American banks could come and set up branches in Lebanon under no supervision from the central bank, on a just purely free market basis that anybody could use those banks. I'd bet a lot of Lebanese people would take their money, whatever is left of it, from the Lebanese bank. Even before the crisis would have happened, this would have happened. They'd take it out from the Lebanese bank and put it in a bank that is not tied to any central bank. Just a free market bank that holds your deposits, charges you a fee for holding your deposits, and sends your payments abroad and charges you transaction fees for every payment you send abroad. It's a very profitable business that doesn't need you to lend to governments. That could be done, but it isn't, because that's not how fiat node works. That's not how a fiat node works. So thinking about these four functions together, you look at the backing the local currency internationally, we see that global reserves in 2020, about 50% were in US dollar, 18% were in euro, 13% were in gold. And then the Japanese yen is at 5, the British pound is at 4, and then there's a whole bunch of others that are under 2%. The Chinese yuan is just under 2%, and a whole bunch of other currencies that are held as reserves by other central banks. But really, primarily, the most important reserve currency in the world is the US dollar. It's more than 50% of international reserves. So that's what the balances of the globe's fiat nodes consist of. The international cash account is, as I said, a monopoly on international settlements. So if you want to send money abroad or trade to the rest of the world, you have to go through them. And then bank reserve, if you want to use any bank, you have to put your money with this monopoly. And then 4, they buy government bonds. It allows the government to borrow and take the entire society's liquid wealth as collateral. The intermingling of these 4 functions in the hands of one monopoly entity protected from market competition is ultimately the root cause of most economic crises globally. It is easy to see how these 4 functions can conflict with one another, and how a monopolist will have the perverse incentive to protect their own interest at the expense of the long-term value of the currency and thus the wealth of their citizens. Central banks effectively face a conflict between choosing a monetary standard for future needs or present needs. Gold is good if you want to hold on to value in the long term because it's not inflationary, but gold is not very good for moving money around, and so they need to use other fiat currencies. This dilemma, of course, would not exist in a globally homogeneous monetary system such as the true gold standard, since gold would offer salability across time and across space. But today, you can't just settle money with gold. So you have to resort to using, there's no international system for clearance of gold, and the US doesn't allow that to happen because the IMF doesn't let any of its members go on a gold standard because they need to protect the dollar's status. So everybody needs to have a conflict. Everybody has a conflict between using gold and using the dollar as the instrument. So governments pressure central banks to engage in inflationary monetary policy, because that is supposedly good for the economy, because they study Keynesian textbooks and they believe them, which is even worse than just studying them. So governments pressure central banks to engage in inflationary monetary policy. People react to that by buying things from abroad and holding foreign currencies instead. Government reacts with tariffs and trade restrictions, as we saw in the example of England on the second chapter of the book. And so by putting the entire banking system, savings, and international trade as collateral for government borrowing, the fiat standard destroys the 3 drivers of economic growth: capital accumulation, trade, and technological advancement. And this is really, I think, the punchline of this chapter, and the punchline perhaps of the book, is that this seemingly innocuous monopoly, the government is just out there looking out for us and helping us trade and deal with the rest of the world. By what they're doing is that they're putting all of these enormously important functions of saving, international trade, and banking in the hands of a monopoly. and using that as a collateral for government to borrow, which is constantly compromising these functions, destroying the value of the currency, destroying the value of people's savings, compromising the ability of people to trade, because now trade becomes an important geopolitical issue, because if you're inflating your currency too much and its value is declining, people are sending stuff abroad and receiving it. That compromises people's ability to accumulate capital, compromise people's ability to trade freely with the rest of the world, and therefore compromises people's ability to import technology and for technological advancement to take place. So all in all, this, what sounds like this innocuous technology is really destroying the ability of the world to grow, and it's destroying the world's ability to have economic growth. Because the real drivers of economic growth, it's not inflationary monetary policy, as your Keynesian textbook explained to you. What drives economic growth is capital accumulation, trade, and technological advancement. All of these are taken hostage by the fiat monetary system, by the fiat node. And I think that has been enormously devastating for the world over the last century. And that is it for this third lecture. I'll see you next week for lecture number 4.